So the first of our financial statements that we're going to have a look at is income statements, also known as profit and loss statements, and you should have probably covered them in a lot of depth in the prelim course. So we should be able to move through pretty quickly. So an income statement, as you'll remember, it's a financial statement that calculates and shows the financial performance for a business over a given period of time. So it's going to be used to show if a business made a profit or a loss. It's going to show the revenue earned in a period, and it's going to match it with all the costs or expenses that were incurred in generating or earning that revenue. So basically, it will tell us if a business made a profit or loss, and it's going to do that. A profit is going to be if revenue is greater than expenses, but it will have a loss if expenses are greater than revenue. So from time to time in the HSC, what they'll do is they'll give you a financial statement and they'll ask you to identify what type it is, or say what is the role of the financial statement shown above. So you need a way of being able to tell what an income statement is. And the way to do that is through some of these characteristics or features. The first thing is it will have the words "for the period ending" in its title. The second element or feature that will help you to know that it's going to be an income statement is it will include revenues, usually in the form of sales. It will have cost of goods sold and a range of different expenses. It will also have gross and net profit there. So if it has those features, it's going to be an income statement. So before we go any further, we need to know what each of these key elements or accounts on an income statement actually means. First of all, we know that right up at the very beginning, we're going to have the title, including the business's name, the words "for the period ending," and what financial year it was completed in. Then we start off with sales. So sales is the income or revenue earned from selling the business's outputs. The next thing that the income statement will do is it's going to have COGS. Now COGS is an abbreviation for cost of goods sold. And basically it is the cost to the business of making or buying the outputs that they sold. Then we need to know about gross profit. So gross profit is the difference between sales and COGS. So it's the remaining profit out of which all of the business's other expenses can be paid. We then look at other expenses. So other expenses are the general costs of running the business. And you should remember from the prelim course that there could be selling expenses, which are related to the marketing costs of the business, such as advertising or commission or delivery. You also have admin expenses, which are basically the business's overheads, the costs of running the whole business, such as rent, electricity, telephone. And then you've got your financial expenses, which are things like your lease payments and your interest costs. Finally, we've got our net profit. And net profit is the profit that remains after all expenses have been paid. And this represents the amount that can be distributed to owners or reinvested back into the business in the form of retained profits. So let's now have a look at an income statement and how we can use it to calculate both gross and net profit. So in this example, we're going to assume that the business had sales totaling $550,000. It cost them $175,000 to actually make the output that they sold. We'll talk a little bit more about how they got that number in a minute. So to get our gross profit, it's going to be sales of $550,000 less our COGS of $175,000, which gives us $375,000. In order to calculate our net profit, the first thing that we need to be able to do is we need to get our total expenses. And our total expenses in this case are going to be our selling expenses of $200,000 plus our admin expenses of $40,000 and our finance expenses of $60,000, giving us a total of $300,000. To get our net profit, what we do is we're going to take that away from our gross profit. So we're going to have gross profit less our other expenses. In this case, $375,000 less $300,000 is going to give us a total net profit of $75,000. So what you need to take away from that little example are those two equations, those two formulas. They will not be given to you in the HSC. You must know that gross profit equals sales less COGS, and you must know that net profit is gross profit minus other expenses. Or you can write it out the long way if you prefer, sales minus COGS minus other expenses. Now, as I said to you before, we don't always get given a total for COGS, so we need to know how to work it out. So if you have a look at this income statement, this time we've got opening stock and purchases and closing stock. We don't have a total as yet for COGS. So before we can work out our gross profit, we need to first work out what our cost of goods sold is. If we're going to work out cost of goods sold, it's our opening stock, which was $100,000, plus the purchases that we made in the period, which was $150,000, giving us $250,000. However, there was still $75,000 worth of stock left at the end of the period. We didn't sell that, so we can't include it in our cost of goods sold, so we take it away. So to get COGS, it's opening stock plus purchases minus closing stock, which in this case gave us that figure of $175,000. Then gross profit is calculated in the exact same way as before. It's $375,000 because it is sales minus COGS. Net profit is again calculated exactly as it was before. We first get our total expenses, which was going to be $300,000, and then we're going to get our net profit of $75,000 because we had gross profit minus other expenses. So our third formula that you must know is that of COGS, opening stock plus purchases minus closing stock. So in summary, what you need to know about an income statement. Its purpose is to show the financial performance of a business over a given period of time, usually 1 year. It's going to tell if the business has made a profit or a loss by matching revenue with the expenses incurred in earning that revenue. The key features that tell you it is an income statement, it's going to have the words "for the period ending" in its title. It's going to have the accounts of revenue, usually in the form of sales. It's going to have COGS, and it's going to have a range of different types of expenses. It's also going to calculate both gross and net profit, or allow you to calculate them. To do that, you need to know three key equations. First of all, COGS, which is opening stock plus purchases minus closing stock. Then your gross profit, which is going to be sales minus COGS. And then finally, net profit, which is going to be gross profit minus other expenses.